Asset allocation and different investment alternatives. Every investor wants to maximize return, their earnings, or gains from giving up surplus cash. And every investor wants to minimize risk because it is costly. To invest is to assume risk, and you assume risk expecting to be compensated through return. The more risk assumed, the more the promised return. So to increase return, you must increase risk. To lessen risk, you must expect less return. But another way to lessen risk is to diversify. That is to spread out your investments among a number of different asset classes. And investing in different asset classes reduces your exposure to economic, asset class, and market risk. Asset allocation. Asset allocation refers to deciding which asset classes and therefore which risks and which markets to invest in. Asset allocations are specified in terms of the percentage of the portfolio's total value that will be invested in each asset class. An asset class is a group of financial instruments that have similar financial characteristics and behave similarly in the marketplace. We often can break down these instruments into having to do with real assets and those having to do with financial assets. Broadly categorized as asset classes include but are not limited to cash and cash equivalents, bonds, derivatives, equities, real estate, gold, commodities, and alternative investments. Asset allocation, therefore, is based on the expected returns and relative risk of each asset class and how it will contribute to the return and risk of the portfolio as a whole. If the asset classes you choose are truly diverse, then the portfolio's risk can be lower than the sum of the assets' risk. There are three methods of asset allocation. One is the income need allocation. It is the liquidity needs of the investor that determines the period of his investment, which therefore limits the choice of investments and its return. Two, the targeted rate of return allocation. It determines what return is needed to reach your goal given the level of risk tolerance that you have. Three, age-based asset allocation. This refers to the type and style of your investments, which should change with age since the investor's needs differ over time. As a rule of thumb, you can apply the formula of 110 minus your current age equals a certain percentage exposure to stocks or equity. And this can also be placed in the equity-based mutual funds as well. In looking at other investment alternatives, let me now show you a diagram on 45 asset classes worldwide. Which of these asset classes within the broad category should you include in your portfolio, and in what proportion? As you can see in this diagram, we start with having real assets, and this has to do with precious metals and even the real estate. They will lower your portfolio risk because of the low correlation with equities, and it's the best hedge against inflation. On the other hand, when it comes to bonds, this is a way to lower also your portfolio risk because of the low correlation with equities, and it's the best deflation hedge, but it is vulnerable to inflation. And finally, on the equity side, this has to do with the highest long-term returns, but also having the highest short-term risk, and this is a partial inflation hedge. So what you could see here is that if you put together the precious metals and real estate, this can give you the best inflation hedge, and you may want to invest at 25% of it. But when it comes to currencies as well as precious metals, this would have a low correlation with equities and maybe want to allocate about 37.5%. And for the equities, this has to do with a heavy exposure of 50%. All of these percentages I mentioned are just a suggestion, but you still have to do the further assessments of the requirements before which you can do any investments as mentioned in the previous topics. Finally, if you don't have time and training tolerance, it's best to hire a financial advisor or a money manager for your investments. Diversification decision. Concentrating investment concentrates risk. Diversifying investments spreads risk by having more than one kind of investment and thus more than one kind of risk. To truly diversify, you need to invest in assets that are not vulnerable to one or more kinds of risk. For example, you may want to diversify between cyclical and counter-cyclical investments, thereby reducing economic risk. Or you may want to diversify among different sectors of the economy, thereby reducing industry risk. Or you may want to diversify among different kinds of investments, thereby reducing asset class risk. And you may want to diversify among different kinds of firms, reducing company risk. To diversify well, you have to look at the collection of investments as a whole. It's your portfolio that is important in terms of gathering separate investments, analyzing and choosing what percentages you must invest in them. If you choose the investments well, and if they are truly represented in terms of diversification, truly different from each other, then the whole can actually be more valuable than the sum of its parts. Active versus passive investing. There's a tug of war between active and passive investing, and the important thing is you should know more about them before you start investing. In active investing, the aim is to beat the market's returns by predicting market fluctuations. This involves buying and selling of individual stocks. For passive investing, it aims to track the market's performance by giving you returns, and this involves buying and holding index funds, exchange traded funds, or a group of stocks. But there are pros and cons for active as well as for passive investing. The advantage of active investing has to do with having the right skill. Investors can outperform the index. It can also take defensive decisions to reduce losses, and you can also make sure that if the risk increase, you can exit specific sectors or stocks. But the disadvantage is that it has less stock efficiency and high fees. On the other hand, when we follow passive investing, the advantage there is that you can buy and hold strategy that doesn't invite high annual capital gain stocks. You can also have lower fees, and there's also transparency for you to know which assets are in the index fund. But the disadvantage of passive investing is that it's less likely to outperform the index. Also, investors are unable to act if the market goes into a decline. So, active and passive investing is important to know before you start investing. Only then choose the one that best suits your ability as well as knowledge to get the most from it. Dollar cost averaging decision. This is a strategy that has to do with personal wealth building. It involves investing a fixed amount of money at regular intervals over a long period. It is also designed to reduce market risk by stretching out the purchase of stocks over time, buying more when prices are low and buying less when it is high, and it effectively keeps your average cost low. Laddering decision. Your investment portfolio is structured in a way that a portion will mature earlier than other portions of investments on a regular interval. It allows you to use the profits earned from that matured portion of the investment to invest into another new investments. It helps you therefore avoid reinvestment risk during unfavorable instances. Rebalancing decision. When should you sell certain assets and when should you buy the market? This is an automatic way to buy low and sell high without your emotions in the way. It therefore allows you to put back your portfolio into its original asset class percentage before any advantages or disadvantages that you are facing in the market. Steps to diversification and investment strategies. So we just found out that in diversification, it has three areas that we need to look into. One is capital allocation. It means that you're diversifying your capital between risky and riskless investments. A riskless asset is the short-term or less than 90 days treasury bill. And because it is such a short term to maturity, it won't be much affected by interest rate changes. And it's possibly impossible for a government to become insolvent or go bankrupt or even have to default on its debt within such a short time. The second one has to do with asset allocation, and we already saw that it has to do with diversifying among asset classes and markets with given risks and returns depending upon your chosen investment instruments. The third has to do with security selection. It is the third step in a diversification whereby you choose individual investments within each asset class. We had mentioned that asset classes can be the likes of cash and cash equivalents, bonds, stocks, mutual funds, real estate, gold, currencies, and the likes. So therefore, the security selection, which is the third step in a diversification, is to choose individual investments within each asset class. And this gives us a chance to achieve industry or sector or even company diversification. And when we choose any of the companies in different industries or companies of different sizes and ages, that will diversify your stock holdings. You will have less risk than if you had invested in just one corporation stock. So therefore, diversification is not defined by the number of investments, but by the different characteristics and its performance. So as far as investment strategies are concerned, capital allocation decidedly is the most important overall in assessing the risk of a portfolio. The asset allocation tries to maximize return, and the return you get from those that you're exposed to, given the risk on the investment instruments. Security selection further diversifies within each of this asset class. So just as a life cycle investing is a strategy for asset allocation, Investing in index funds is a strategy for security selection. Indices are a way of measuring the performance of an entire asset class by measuring returns of a portfolio containing all the investments in its asset class.